Okay, let's see if we can continue our discussion of the impact of financial distress on capital structure. Excuse me. So let's go back to our company, our original example, right? Company's going to have a new project with all equity financing. It's either worth 150 million or 80 million. So what is the impact of financial distress? Let's assume that the cost of financial distress in the end is going to reduce the value of the company if the product fails from 80 million to 60 million. So the cost of financial distress we're going to assume is $20 million. So how does this ultimately then affect the company? So again, we're going to assume that the risk-free rate is 5%. New products equally likely, the risk is diversifiable, etc. So nothing in our scenario has changed. So now what's the new value of the firm? To the value of the debt, it's again 50% times the $100 if it's successful, but now the value is only 60 million if it's unsuccessful. So the present value now of debt is $76.19 million, which obviously is a decline from the previous amount. So if we combine this now, you have what? The value of a levered company, value of equity and debt. Equity has a value of 23.8 million. Debt now is 76.19. That equals the 100 million, which now is less than the value of what we talked about when we calculated the value of the unlevered firm, which again was 109.52 million. So this decrease in value of 9.52 million is due to bankruptcy costs. So can we do a little check on this, right? So if you find the present value of financial distress, that is this number. So we've said what? If we're successful, there's a 50% chance there's no financial distress costs, but there is a $20 million cost if it fails. And the present value of that is $9.52 million, which is what we've just verified from up above. So for Armin, if the product fails, equity holders lose their entire investment and they won't care about bankruptcy. However, it's the debt holders that care. They recognize that if the product fails, the firm's going to default and they're not going to get the full value of the assets. So as a result, they're not going to be willing to pay as much, or the value of the debt that they purchase, they're not going to be willing to give them as much money so that they can obviously account for this additional risk. If they pay less for debt, that means the company has to come up with this money somewhere. So it's not going to be able to pay dividends, not going to be able to make investments, might not be able to repurchase shares. So in the end, they do ultimately pay for this. It's just the actual cash payment, if you will, comes from the creditors' pockets, even though the shareholders ultimately are kicking it in. So we've mentioned this statement in a variety of forms before. When securities are fairly priced, the original shareholders of the firm pay for the present value of the cost of leverage, and in this case, the costs associated with financial distress. So let's kind of come back and rethink this a little bit. How does this affect stock price? So let's assume we have 10 million shares at the beginning of the year and there's no debt. We're going to announce a plan, a 1-year debt with a face value of $1 million. And we're going to use those proceeds to repurchase some shares. Again, given the data that we have, we want to calculate the new share price. And again, assume all the particulars from the previous example. Risk-free is 5%, equal likelihood of success or failure, and the risk is diversifiable. So, from our beginning example, 16.1, the value of the company without leverage is 109.52 million. With 10 million shares, that means the price is $10.95. If the company has leverage, the total value of the firm is only 100 million, right? So again, the cost per share, or the value per share divided by the 10 million shares, is $10 per share, based on when they announced this recapitalization process. So again, in example 16.2, let's verify this result, right? So what happens, again, we're talking about what happens to the value of the stock. Because of bankruptcy, this new debt is now worth 76.19 million. So at a stock price of $10 per share, the company is going to be able to repurchase 7.62 million shares, leaving 2.3 million. And again, we calculated the value of this equity, the value of the levered equity in 16.1. We said that that value is $23.8 million. So again, if you take the $23.8 million in value divided by the 2.381 million shares, we're now back to, again, it's $10 per share. So this recapitalization is going to cost the shareholders roughly $9.5 million in total. And this, again, if you think back to a couple slides, this matches the present value of financial distress. So again, although the debt holders bear these costs in cash, the shareholders ultimately pay this from the present value of their of the company when they make announcements of these trade-offs and this recapitalization process. So we're going to try to explain what this all means now. How does financial distress ultimately impact the value of the firm? We have something that's referred to as the trade-off theory. The company is going to pick a capital structure, and the things that they're going to trade off are the benefits they get from the tax shield and the costs from financial distress. So according to this trade-off value, the total value of a levered firm is the value of the company without leverage, and then we incorporate these extraneous benefits and costs. So our formula here, you add the tax shield, you subtract the present value of the financial distress. So there's three key factors that we have to determine to figure out the present value of these distress costs. Number one is, what is the probability of financial distress, right? It obviously increases with the amount of liabilities that the company has. So the probability of financial distress increases with the volatility of the cash flows of the company and asset values. So we know that probability of distress changes, and it changes in an increasing way. The second factor is that the magnitude of these costs we have to determine the magnitude of these costs after a company is in distress. It's going to vary by industry, right? Technology companies are going to incur high financial distress. A lot of it has to do with the loss of customers and key personnel. Real estate firms are likely to have rather low costs because most of their assets can be sold relatively easily. So Again, we've talked about the probability increases with debt, increases with volatility. The magnitude also increases based on the kind of industry that the company is in. And finally, the appropriate discount rate, right? How do we figure out what this discount rate is? And again, this depends on the company itself. It depends on the firm's current market risk. Because distress costs are very high when the company does poorly, the beta of distress costs has the opposite signs to that of the firm. So again, the higher the firm's beta, the more negative the beta of the distress costs will be. So again, the present value distress costs are going to be higher for higher beta companies. And I think this makes sense, right? If high beta companies designate or identify high risk companies, then it would make sense that the present value of financial distress would increase for those high risk companies. So for low levels of debt, the risk of default's pretty low. As the level of debt increases, the probability of debt increases. So this trade-off theory essentially states that companies should increase their leverage until it reaches some level that they obviously are trying to maximize the value of the company. And at that point, the tax savings will be exactly equal to the present value of the potential financial distress. So this trade-off theory can actually help us explain, why do companies choose debt levels that are too low to fully exploit the interest tax yield? It's because there's another cost to incorporate. And differences in the use of leverage also are present across different industries. So if you kind of think about how this graph, we've been working with this graph, we know here's V sub U, and we know that with just the tax yield and not financial distress, we have this straight line, right, that just says you should maximize debt. But now what we're saying is, dependent on the kind of industry that you might be in, the kind of company that you might be running, you're going to have a curvilinear function of value. And what that means is, as the company borrows more and more money, you always get this tax yield, but eventually the financial distress costs are going to start to eat away at that benefit, and there ultimately is a point where there's going to be an optimal amount of debt for the company to have. If you have more debt than that, the value of the company then starts to decline. So the concept of this trade-off model is that we're going to maximize the value of the company by choosing that debt level that equates the tax shield benefits to the present value of financial distress. So we'll move on to the next video.